morning, everybody. We're going to go ahead and get started. My name is Katie Ensweiler. I'm the marketing manager here at VonLehman, CPA and advisory firm. A few housekeeping items. We are keeping everybody on mute without the ability to unmute themselves. So if you do need to unmute yourself for any reason, please send me a message and let me know. Otherwise, we will be taking questions in the chat feature within Zoom and answering those at the end of today's presentation. We are recording it as well as sending out any documentation that we do present. So if you do need to leave early or miss something, we will be sending that out later on today or tomorrow. And before I introduce our speaker, Tom, I'm going to turn it over to Beth Weiss.
Thank you, Katie. Good morning, everyone. I just wanted to let everyone know that we really appreciate you joining us this morning. We want to thank Fifth Third for partnering with us on this event again. Many of you may have been at the event we did last year. We did an economic outlook event with Fifth Third last year as well at the end of January. It was in person. I think it was probably one of our last in-person events. So we have that memory to hold on to, and hopefully we'll get back there soon someday. I'm thankful, though, that we're still able to do this and do it in this environment, even though we can't do it in person. But just wanted to say thanks again to Fifth Third, and we are very, very honored that Tom is with us again today. He is a genius when it comes to this stuff, and we're excited to hear what he has to say. So thank you, Tom and Fifth Third, and Katie, I'll kick it back to you.
Great, thanks, Beth. Did you hear that, Tom? We're expecting a lot, so.
That's a lot of pressure. I don't think I'm up for it.
I'm going to go ahead and introduce Tom, our speaker. Tom Jalics is the Chief Market Strategist at Fifth Third Bank, where he is responsible for leading the investment management group's asset allocation process, both strategic and tactical, which informs the management of the $29 billion in assets under management at the bank. He provides internal and external communication on the economy and the markets, making public speaking and media appearances on behalf of the bank. Additionally, Tom is a discretionary investment portfolio manager focusing on high net worth clients. Prior to his current role, Tom was Director of Asset Allocation at the firm. Tom, I'll turn it over to you.
Thanks, Katie. Thanks, Beth. It is great to see your faces. I think the January meeting a year ago is one of the last ones that I did in person as well. And I think we're going to get back to those in-person meetings in the not too distant future. At least I'm trying to be optimistic about it. These Zoom meetings are great, but I'll tell you, I miss that personal connection and just seeing people face to face. I'm sure you all too. I'm going to put up some slides and then we'll run through it all. Hopefully you guys can all see this. As Katie mentioned, I'm the Chief Market Strategist for the Investment Management Group at Fifth Third. It's a fancy title. All it really means is I lead a group of investment professionals, and ultimately our job is to make investment recommendations on behalf of our clients. One of our core tenets, one of the things that we feel that if we get right, we'll make better investment decisions on behalf of those clients. They'll be happy. I won't have to go looking for a job. You know the drill. So the core tenet really is if we can properly identify where we are in the business cycle, be right, we'll make fewer investment mistakes. And it sounds like an easy job. There's kind of four phases of the business cycle that we look at. It's recession, early expansion, mid expansion, late expansion. Again, markets are and economies are dynamic. They're not static. They're changing all the time. And if you nail that one right from an investment perspective, typically you can expect reasonably solid investment returns. So today, not to belabor the point, we think we're at the very beginning of a new economic expansion. First inning of a new expansion. Maybe the first pitch of a new inning. I know it doesn't feel like it. It still feels like we are recovering from a pretty nasty recession. Obviously, that we understand that, and there are certain aspects, there are certain industries within our economy that have not come back. There are other sectors and industries that are coming back like gangbusters. So we don't want to belabor the point. We know that there are many in our country that are suffering economically and otherwise. We've been calling these industries that still haven't reopened kind of the scene of the crime industries. These are industries that you really can't socially distance from. And unfortunately, it is all the things that we like to do on top of, being big job producers, big part of our economy. It's leisure and hospitality, retail, bars, restaurants, hotels, airlines, movie theaters, cruise ships, casinos. These are the industries that you really can't socially distance from. And these are the industries that are still struggling. And these are, primarily why we're still seeing out of Washington more conversations about more fiscal stimulus, more help to keep these industries up and running. That's the bad news, that these industries are still struggling. Maybe the good news, to kind of put those industries in perspective, they make up about 9% of consumer spending. And that's important in that, our economy, the U.S. economy, is driven by people like us that have jobs, earn wages, and spend those wages. It's driven by consumer spending. 68%, let's call it 70% of our economy is driven by consumer spending. Really, 90+% of our economy has started coming back. And we're seeing it in the unemployment rate. We're seeing it in jobs numbers. We're seeing it in manufacturing activity. We're not seeing it in these the crime industries just yet. Our kind of view is, again, we're at the beginning of a new economic cycle. These cycles, if past as prologue, tend to last for many quarters and many years. And that has big implications if you are an investor. It has big implications if you are a business owner, or we'll talk about those. But we're trying to paint a relatively optimistic picture of where we are going to go. Again, I think this one part of the economic piece of the puzzle is not there yet. I think what we're going to need to talk about there is vaccine adoption, inoculation, and confidence until the rest of those industries come back. And we'll talk about that in a second. But our title of our conversation today is called The Great Disruption. And we really want to talk about framing kind of where we are today and what we should expect in this post-pandemic economy. There are things that are happening, that have happened over the past year, that will kind of supercharge some trends that we think are really important for either business owners or for investors. And we're going to talk about those now. Again, I think the last piece of the puzzle to get us back up and running from an economic perspective is out there. The early days of the vaccine in December were a little rocky as far as distribution and logistics were concerned. Things are getting better. We're inoculating upwards of about 1.5 million people a day. A little bit more than 40 million people have had their first dose so far. And it's going to the people that need it the most. And I think that has real implications for the rest of this economic reopening that we're looking at. But make no mistake, the pandemic, the recession last year was nasty. It was deep. It affected a lot of people. If we rewound a year ago, I was telling you that we were at an unemployment rate in January of 2020 of about 3.5, 3.6%. That was the lowest unemployment rate in the United States in 50 years. You had to go back to December of 1969 to get an unemployment rate that low. And again, that's important because when the unemployment rate is low, we're a consumer-based economy. People have jobs, they earn wages. They spend those wages. And, we got it wrong last year. We did not think we would see a recession. Typically what you see in normal business cycles is there's either some malinvestment in one part of the economy that ultimately goes bust. 10 years ago, it was domestic housing. Or you have this, death by 1,000 cuts where jobs are tough to get. The unemployment rate is really, really low. Job wages start to rise. Inflation starts to rise. The Federal Reserve sees inflation start going up, and it starts increasing interest rates to curb inflation. When interest rates go higher, that's a disincentive for businesses to borrow and invest. When you have a disincentive, that's exactly what happens. You don't. And over time, you see the economy and economic growth kind of grind to a halt. That's a normal business cycle. That's not what we saw last year. What we saw last year was basically the government, to their great credit, in our opinion, shutting down all businesses around March 12th, 13th to protect the citizenry from really an unknown exogenous shock, an unknown health scare. And our opinion, again, is that was the right move, but we went from a fully productive economy where the lights were on March 11th to basically a week later, the lights were off on our economy. The unemployment rate, like I said, went from about 3.5, 3.6%. In about a month's time, it went to almost 15%. That's a massive amount of job losses in a really short amount of time. That is the exogenous event that we didn't see. That's where we got it wrong last year. We weren't the only ones, but it's fair to say that it didn't come out of nowhere. We had been hearing about the virus for a few months, December, January, February last year, but the economic and social and societal impacts, I don't think we got right. I don't think most people in financial markets got right. That's the bad news. The good news is that when you don't have this buildup of bad investments in a certain sector of the economy, you can come out of a recession pretty quickly. 10 years ago in the financial crisis, because we had spent many, many years building up domestic housing, we had this overhang of credit. Lots of people qualified for mortgages that probably couldn't. Those mortgages ultimately, in many cases, went bankrupt. We built way too many houses, way too many condos, and way too many apartment buildings. And there was about a 3.5 year overhang where we saw it in the stock market. The stock market kind of peaked in 2009. It really didn't get back to its prior peaks until about 2012, 2013. Again, that's because you had this large overhang. That's why this recession of 2020 is different. We didn't have this overhang. And this is why the primary reason why we believe we've come out of it much, much quicker. It really took, as measured by the financial markets, it really took about 100 days to go from a high in the S&P 500 in February of 2020 to a low on March 20th of 2020, and then back to a high midsummer. It took about 100 trading days. That's unusual, but that's a core tenet of a short and nasty recession. And again, we're out of it today. We're more optimistic about the future for a few reasons, but it's made some changes to how I think we're all going to think about doing business. One of those reasons, or one of the things that is going to change about doing business is this government stimulus that we've gotten. The fiscal policies and the monetary policies that we've gotten from our government really kickstarted the recovery. It built a bridge kind of over an economic chasm, and that's really helped our recovery. And again, kind of supercharged the recovery, and has really made the downturn less invasive than it would have been otherwise. And that's a positive thing. Longer term, our expectation is we're going to have low interest rates for quite a while. That's probably a good thing for business owners who are trying to refinance their debt. But there are longer term issues that we're going to discuss a little bit ahead. Again, near term, the help from the government has been an absolute boon to economic activity, but there are some long-term challenges there with it. So let me keep going. So the first slide here on page 3, there's a lot going on here. This is a look at where we are today with the virus. The gray bars are your case counts, and they correspond to the right-hand scale. The green and the blue bars correspond to hospitalizations and fatalities, and they correspond to the left-hand scale. Our view on the virus is it's obviously still here. The trends are very positive, and we have a vaccine that is now here. We don't need to get necessarily to full herd immunity from a population perspective. And what you can kind of see is the case counts, those gray bars, there's a plurality in that 18 to 29-year-old range where, that's the highest cohort of case counts. But what you can see, again, with the blue and the green line is that hospitalizations and fatalities on the left-hand scale, 80% of the hospitalizations and fatalities, the worst part of the virus, really affect cohorts that are 65 years and older. About 16.5% of the U.S. population is 16.5% or older, and they account for, again, about 80% of the fatalities and hospitalizations. This is a cohort that is now being vaccinated. Again, about 40 million people, a little bit more, have gotten their first shots. And we're already starting to see case counts are down about 75% from their peak in December. And our expectations are that we're going to see fatalities and hospitalizations quickly decline. And that has implications for economic reopening. Again, it's really great from a societal and social and health perspective. It's also really important from an economic reopening perspective. And again, I think it's going to affect those seen in the crime industries that I mentioned before, right? All the things that we like, hospitality, travel, leisure, airlines, casinos, cruise ships, movie theaters, sporting events, and the like. There's a better chance that those sectors of our economy will reopen quicker as local governments, state governments see case counts and fatalities in, again, the most affected cohorts decline. We're starting to see it now. Most investors, if you talk to them, expect our economy to really pick up steam in the second half of the year, maybe the mid third quarter, early fourth quarter of the year. I think we're a little bit more optimistic in investment strategy group at Fifth Third because, again, 16.5% of the U.S. population is in that 65 and up category. They're the ones that are getting the vaccine. They're adopting it today. We're seeing the first case counts plummet, which is great. Again, down 70-some-odd% from December peaks. We're going to see hospitalizations and deaths likely follow because, again, those are the folks that are getting the vaccination and the most affected by the worst parts of the coronavirus. And then once you see that, you're going to see, again, state and local governments become more lax about those industries that you're still socially distancing from. So our expectation is a little bit more optimistic than I think what is consensus out there. We're thinking late second quarter, mid second quarter, we're going to start to see some of these seen in the crime industries show better results. And again, that is the one piece of the puzzle that will help drive lower unemployment and higher economic activity and productivity. That's a really good thing for business owners and investors, in our opinion. Again, a little slide here, page 4, on progress on the vaccine. I think you guys kind of know what's happening here, so I won't belabor the point. On the bottom left, globally, there's 4 vaccines that are approved for full use in various countries. In our country, there's 2 currently, the Pfizer vaccine and the Moderna vaccine. Our expectation is there's going to be 2 other vaccines, short order, that will be approved, one from Johnson & Johnson, J&J, and another from a combination of Oxford universities and AstraZeneca. I think we're going to have 4 vaccines in our country here in the next month or 2. And again, it should supercharge the vaccination process, which could then, again, supercharge that reopening process for that last part of our economy that is still struggling. On the right-hand side, just some information from the CDC on who is likely to get the vaccines. Again, higher risk populations first before the rest of the population. But I think we've known this. This is nothing new. CDC, Dr. Fauci, Dr. Birx, they've been telegraphing this for many, many months. And that's exactly what's going on today. But again, lots of progress on the vaccine front, reasons to be optimistic going forward. But a look at, what we should think about as far as the economy is concerned going forward. Again, things have and were disrupted over the last year. It's not affecting all industries the same, as I mentioned. Again, manufacturing is doing reasonably or quite well. Housing domestically is doing quite well, but those crime industries are not back yet. So industries have been disrupted. Where we spend our money, how we spend our money, where we learn, how we learn, these are all changing. And I think it's been supercharged by what we've kind of seen over the last 12 months with the disruptions with the pandemic. It's going to affect geographies, and it's going to disrupt government policies on how interest rates are concerned. And that may affect future growth and future inflation. So let's talk a little bit more deeply on some of the things that we've been watching. This is one that anyone that has kids should pay attention to. I have 3 children, 14, 12, and 10. They're really wonderful kids. I always joke with them that they're not college material. Ha ha, bad dad joke. But what we see is that in the past year, this is year-over-year change, fall of 2019 to fall of 2020, undergraduate enrollment. And what we know is that over the past 20 years, enrollment in universities has been ticking higher, of course, as our population grows and more people are going to school for college educations. What we've also seen is that cost inflation of undergraduate education has averaged somewhere between 7 and 9% a year, depending on how you measure it. That's compared to regular inflation that's been around 2% a year. The cost of college, I don't need to tell you, is very, very expensive, and it's been going up and up and up for the last 20 years. And what we saw over the last year is that students and perhaps parents really thought about whether they wanted to send their kids to college in the fall of 2020. And all cohorts here that you see saw declines in enrollment, except for private for-profit four-year institutions. Those are typically online schools. One example would be the University of Phoenix. Again, but you saw public 2-year, that's your community college all the way to the right, saw enrollment decline by 10%. Private nonprofit 4 years, public, that's your kind of liberal arts and private 4-year undergraduate educational institutions. Public 4-year are your state schools, and overall the all sectors were down about 3.6%. Again, some are saying that this is a 1-year trend and that parents and students were concerned about sending their children into college when they may not get the full experience because classes were either partially virtual or all virtual. There's other thoughts that would say that there was accommodation for older workers that needed more flexibility and instead chose to go this private for-profit 4-year online kind of schooling. I think what we're seeing in one of our views is that there's a big disruption here happening. There's about $1.7 trillion in total college debt. It's very expensive. It's a big burden for individuals that spend 4 years and upwards of hundreds of thousands of dollars. And now that there's technology that exists that you can learn remotely at a much lower cost, it's going to really affect how people think about spending their hard-earned dollars, taking out debt for future college enrollment. Again, we're not sure that this is a 1-year trend, that overall undergraduate enrollment is down. We do think that there's a real possibility that given the technological advances that have been made, that there will be more online learning, and that will affect how the traditional university system operates from a budget perspective and a cost perspective. It might be good for future people that go to school where costs will have to be curbed, and that will be good for the bottom lines of the individuals that either take out debt or spend money. But I think this is an interesting piece of data that we think is going to happen going forward, given the technological advances that have been made. I mean, look at us, we're doing a Zoom meeting instead of an in-person meeting. This translates well to undergraduate learning as well. So this is something to keep an eye on. The other thing that's no surprise is that we've seen a supercharged spike in online or e-commerce sales. This is a chart of total e-commerce or online sales as a percent of total sales, retail sales, going back 20 some odd years. Again, to no one's surprise, this green line has been going up and to the right very, very steadily for the last 20 years. Those gray bars are your recessionary periods. And you can see all the way to the right on this chart, what we saw was obviously when our economy domestically was shut down in March and April 2020, and you couldn't go out to your traditional brick and mortar retail store, you saw a massive, massive spike in online retail sales. So again, this trend has been in place for 20 years. It's been steadily growing over the course of the last 20 years. Back in March and April of 2020, this was a massive exponential spike in retail sales. And again, it's because there was nowhere else to spend the dollars in person in traditional brick and mortar stores. Again, we think this is going to come down a little bit from where we were. It's already starting to come down. So, as businesses reopen, as the economy reopens, you'll see more brick and mortar stores reopen and people spending a little bit more in person. But make no mistake, this green line is going to continue to go up and to the right over time. And this has implications for investors, how you want to think about investing in retail. And our preference would be that you do want to have your investment dollars in the retail area, where you can have brick and mortar retail, but they have to have a massive online presence and a wonderful back office logistical background. This is going to continue. It has caused some bottlenecks with that big spike up. I think we'll talk about that maybe in the Q&A for our at the end of the conversation here today. But make no mistake, this is one of these supercharged trends. You can see it in this chart. Picture tells 1,000 words. We think it's going to come back down a little bit. But again, there's things that are also going on where there are historical barriers to entry for big ticket items in retail, like cars or trucks or even home sales. Those barriers are being knocked down today, and that's one of our reasons why our expectation is green line is going to go up and to the right. But again, for investors or business owners to just have a sole brick and mortar store without a wonderful online presence and a great back office logistical supply chain, we don't think is a winning long-term business model. Another kind of supercharged trend, to make no surprise, given where we're all doing this Zoom, I think the majority of us, is the work from home trend. It is here to stay, and it is going to be a big disruptor of where we work, how we work, who we work for. It's going to have effects on commercial real estate. It's going to have effects on residential real estate. I think it's going to have effects on where businesses are located, and it's going to affect migratory patterns, not only of businesses, but individuals as well. So there's a lot going on this slide. This is from some survey work done from a firm called Upwork. We've looked at, this data is tough to get, and it's not complete. There's a couple studies out there. One is from the state of Oregon that has very similar data, just looking at their own state as far as work from home pre-COVID and post-COVID. There's a University of Chicago study out there that has very similar data. The University of Chicago study believed that only about 37% of all jobs could be work from home. So I think that's something that is potentially to watch for today and what may change in the future. But where we are now, if you go all the way to the left, the gray bars are not remote at all. So prior to COVID, 80% of jobs were not remote at all. About 20% were either fully remote or partially remote. April 20th of last year, that's about a month into the shutdowns, into quarantine. And you basically had a switch where you went from 80% of jobs were in person down to about 40% of jobs were in person. Then you went, again, a big switch to 60% of jobs were either fully remote or partially remote. Today, where we are, things are coming down. That fully remote or partially remote numbers are coming down, as we would expect, as businesses are reopening, as the economy is reopening. People are going back to the office, but it's still very high in relation to where we were. And then they also did surveys on where we're going to be a year from now, where we're going to be 5 years from now. And if I had to put a bow on this page, I would say that it looks to us, if these numbers play out in some form or fashion, you're going to have basically a doubling, a little bit more of work from home, either fully or partially between now, or before COVID, and where we're going to be in 5 years. We think that's directionally correct. Again, we're not sure that these numbers are going to play out in perfect order as this survey would suggest. But if this work from home trend continues, and we believe it will, it has big, big implications for the workspace, for commercial real estate, for residential real estate, for where businesses are located, and also where people are located. It's going to affect migratory patterns on both sides. Here's one of the disrupted kind of industries. So we talked about learn from home, we talked about spend from home, we talked about work from home, and those kind of in combination will have disrupted some industries, and I think we'll have longer term implications. Here is looking at transportation. There's a lot going on this slide as always. We try to confuse and confound our clients and our prospects, so let me try to walk you through this. On the top left is a look at public transit ridership in the United States. Top right is Uber monthly active users. Bottom left is U.S. airline revenue passenger miles. And the bottom right is auto and light truck sales in the United States. Let me talk about two of them real quickly. On the top left, public transit ridership, as we've gone through quarantine and the worst of our lockdowns, really fell off of a cliff and it has not come back. This is something that might look very different in our big cities going forward. When you have such a decline in ridership, that has massive implications for the budgets of these public transits in various larger cities in the United States. And that's where public transit really is most prevalent, as you all well know. It's New York, it's San Francisco, it's other large Chicago, other large cities in the United States that we're heavily reliant on public transit ridership. Typically what happens when you have this kind of a decline in ridership, you have a big decline in revenue, you have a big decline in services, and you have this negative feedback loop where things struggle, you have service cutbacks, budget issues. I think what we're going to see in the big cities is there's going to be different ways where we work, how we work. There's going to be different commercial real estate implications. Our expectation is businesses, if they can have their workforce work remotely or work from home, they will cut down on their leases, expensive leases in our largest cities, and there'll be less of a need for their employees to work close to those hubs. And I think it has implications for public transit ridership. Public transit ridership actually peaked in our country in the 1920s. I know it's hard to believe, the population was about less than half of what it is today in the 1920s. But again, we were a more densely populated urban community in the 1920s. Public transit ridership, we're very concerned about what that looks like 2, 3, 4, 5 years from now, given the big decline and the budgetary issues that are there, no doubt going through. On the bottom right, something that kind of dovetails right into that public transit ridership. People weren't comfortable getting on public transit during the worst of the shutdowns and quarantines. People were buying their cars and trucks. This is no surprise. There's been kind of a shift in preferences. American consumers love their cars and trucks. It allows them freedom. And in this time of the pandemic, it gave people safety. So you can almost see that green line in the bottom right of the chart. Again, that's your autos and light truck sales through the early part of 2021. They basically have come back all the way. Our expectation is that this is going to continue because we do think some of these public transit ridership issues will persist. Our view is that, I'll show you in a slide or two, that there's going to be some move away from very densely populated parts of our country to more suburban or rural parts of our country. There, you won't have the public transit ridership opportunities. You're going to be buying your cars and light trucks. What you buy might change. The internal combustion engine, traditional gas-powered cars still are the overwhelming majority of the vehicles sold today. EV is making a big impact, and that is a trend that we think will continue going forward. But people in our country, at least over the last 6-7 months, have shown that they continue to love their cars and love their freedom. And given the options out there, that's a trend that we think has been supercharged and will continue going forward. Talked a little bit about changes to real estate. I think this is likely to continue as well. This is a chart of the performance in the public markets of some real estate investment trusts. That's what REITs are, real estate investment trusts, in different sectors of the real estate market. On the positive side, on the right-hand side, you've seen the S&P Home Builders Index. Again, home builders are exactly what you think they are. They are companies that primarily build, construct single-family, multifamily, and apartment homes, and data center REITs. Think of these as server farms. These are areas of the real estate market that have done extraordinarily well over the last 13 months, as measured by investor performance. And investors have voted with their dollars, and they've been bidding up home building stocks. They've been bidding up data center stocks. That's the good news. Those trends, I think, are likely to continue as well. The home builders are cyclical, but when you have very low interest rates, an economy that's rebounding, the jobs picture is improving, and there are people moving around the country. There's moving happening. There's migration. That should be a trend that will persist for home builders. The data center REITs are exactly what you think they are. Again, server farms, cloud-based investing. Again, the economy is moving more digital every single day. These are areas of real estate that we think will do well. But on the flip side, you've got retail and office real estate investment trust REITs that are down 20% from their year-end 2019 perspective. Again, investors are telling you that these are areas of real estate that are going under a transition, and not necessarily a positive transition. We'll keep watching these trends, but as investors, we'll be very cautious on the two left-hand periods, a little bit more optimistic on the two right-hand graphs here. Again, we don't think it's affecting just business. We think it's going to affect consumers. Again, the data is still in early days, but there is information to suggest that there has been movement from higher densely populated areas to less densely populated areas. Because some of the examples we've seen is that there's been some movement from Manhattan out to Brooklyn, out to Long Island. More for sale signs in the city, home prices that have been declining in the city of Manhattan. And then there's also been, more purchase activity in Long Island, in Queens, in Brooklyn. Again, still densely populated areas, but less densely so. And home prices there have been rising. These are a couple headlines from Crain's Chicago Business or CNBC. We think, again, with this notion of people working from home, the ability to be remote doesn't tie you necessarily to a geography. If companies are going to allow their employees to be remote and give them that freedom, I think people will take them up on that offer, and there'll be some migration from densely populated areas to cheaper, less densely populated areas. The next time we talk about this, we'll have more tangible numbers to show you, but it's starting to show up in the numbers. I think geographies are going to be affected too. Here on page 12, we're looking at information from surveys from the Site Selectors Guild, which is an industry guild that asks large, mid, and small businesses, where do you expect to see growth from your office footprint going forward? And really, on the survey data on the left, these businesses are so far only voting in surveys to suggest that there's going to be some migration out of large urban areas towards suburban, mid-sized urban areas and rural areas. And some of the cities that have most come up are on the right-hand side. Again, these are mid-sized cities. These are not your New Yorks, your Chicagos, your San Franciscos, your Bostons, your LAs. For us in the Midwest, I think, you look no further than Columbus, Ohio. It's an area that has been talked about for potential growth. Again, but these are mid-sized cities. Again, if this work from home trend continues, we do believe it will affect how corporations think about their commercial real estate leasing footprint. And then it will allow more flexibility for employees to migrate potentially to places where it's a little bit less densely populated, a little bit cheaper to live. And again, that same thing for the corporations. You'll see probably for sale signs, leases in Boston, New York, Chicago, and you might see more offices popping up on that list to the right. I think that's a trend that will last for likely many quarters and many years if this work from home trend continues, which we believe it will. And for individuals, this is a kitschy slide that we like to put up here. It is a look at the top 5 in the bottom 5 net U-Haul rentals per state. Again, people coming in on the top 5, people are moving, at least by these U-Haul measures, to Tennessee, Texas, Florida, Ohio, Arizona. We think it's a combination of 2 things. It is less densely populated, or maybe 3 things: less densely populated, better weather, and maybe most importantly, very low state income taxes. So you can see Tennessee, Texas, Florida have 0 state income taxes. Arizona pop in there; it's low, nice weather. Ohio's interesting. I live in Ohio. I live in Cleveland, Ohio. We're talking to everyone that either lives in Cincinnati or the suburbs thereof, I would suspect. It's good for our state in that this is a movement from more densely populated areas to less densely populated areas. It could benefit the Midwest, but I think it's going to benefit warmer areas that also have very low state income taxes. On the right, to no one's surprise, it's largely the Northeast and Illinois and California. Again, very high state income taxes in New Jersey, Maryland, Massachusetts, and California. And outside of California, those are more or less cold weather climates. But again, they're also very expensive places to live. Again, I think there's been a migration from very expensive locales to less so. And expensive, you can cut 2 ways: one, by your state income tax rates, but also by your housing stock. It's much cheaper to live in places like Tennessee, Texas, than it is in California, New Jersey, and Illinois. Let's keep moving. I'd be remiss if we didn't talk about politics and policy. Dad told me a long time ago, be careful about politics and religion in a mixed company, but I think it's important to at least touch on this given what we've gone through in our country over the last couple months from a political standpoint. So I think the most important things to talk about here, and it's important for investors and business owners alike, is that obviously, I don't need to tell you, you all know, is that the Democrats hold both seats in Congress as well as the presidency. Again, it's a slim majority, especially in the Senate, where it's a 50-50 tie. If votes come down to complete party lines, the vice president will be the deciding vote. And of course, she is a Democrat. She will likely sway it towards the Democratic side. It has implications for legislation, this Democratic blue wave. It has implications for taxes. It has implications for fiscal stimulus and trade. Let me talk a little bit about all of those. There's going to be a regulatory shift over the past 4 years, from 2016 to 2020, under the Trump administration. Regulations were lowered in many key industries, including energy, healthcare, financial services. There are either tax subsidies or less regulatory red tape to do business in those 3 key industries. That's going to shift. There's going to be more regulations in those key industries. Energy, there will be taxes and or an emphasis away from fossil fuels under this Democratic regime. In healthcare, there'll be a push for lower drug prices, which will be great for consumers, not necessarily good for the drug companies themselves. We don't think that, given the slim majority that we see in Congress, that there is enough will to move to a single-payer system. But regulatory shifts will happen. There will be a higher regulatory burden in healthcare going forward. Then finally, financial services, the largest banks may have to, and financial service companies may have to have more capital, which will lower returns on investment, returns on equity. There'll also be positives. There'll be more consumer protections, which again will be very beneficial to individuals. But there'll be a regulatory shift towards more regulation, not less, in this regime going forward, at least for the prospective 2 years, so midterm elections in 2022. There's going to be higher taxes, we believe, at some point. We think there's going to be higher statutory corporate tax rates. The current statutory corporate tax rate is 21, 22%. It was lowered from about 35, 36% in January of 2018. Our expectation is at some point that 21 or 22% statutory corporate tax rate will move up to 27, 28%. And personal tax rates for those higher income individuals or families will be going up. The expectation there is adjusted gross income above $400,000. Top tax rates will go from 37% to 39.6%. Many people believe that this is going to happen in 2021. We're not sure that that is true, but we do think these higher tax rates are coming. It's more likely a 2022 event, at least in our eyes. It's going to be very hard politically to push through higher taxes while the economy is still healing. I think a good tell there would be when the unemployment rate, which sits at 6.7% today, goes back down to the 4-ish% range. I think our politicians will say the economy is on strong footing. Then it will be more politically feasible to raise taxes. The other two tax rates that are likely to go higher at some point are dividend income tax rates for investors, capital gains tax rates for investors. Again, those sit at generational lows today in the low 20% ranges. We don't think those are going to double, but we think those could go from 22% to 27, 28%. We think those are likely to go higher as well. Positively, there's going to be more stimulus. We passed the CARES Act in March, April of last year, $2 billion in change in fiscal stimulus through the Paycheck Protection Program, direct funds into people's back pockets. And then another $900 billion in December, and President Biden's talking about another $900 billion in December. President Biden's talking about $1.9 trillion more in help today. We think that's going to get passed in the next 3 to 4 weeks. It probably won't be $1.9 trillion, but it might be on the order of magnitude of another $1 trillion. This is really going to help supercharge the economy, at least in 2021. Finally, on the politics, policy, regulatory front, we think there's going to be lower trade tensions, particularly with allies. So negotiations with Canada, Mexico, Europe will be a little bit less contentious than they were during the Trump administration. With China, we still think tariffs and trade will be an issue there. Our government, it's really a bipartisan, in our view at least, regime today where China is seen as an adversary, not an ally. We don't think there's going to be additional tariffs placed on Chinese trade, but we're not sure that the tariff situation is going to go lower from where it is today, given that there is an adversarial tone in the negotiations that will continue and persist under the Biden administration. It won't look as contentious as what we've seen over the last 4 years, but make no mistake, this administration feels similarly to the previous administration in that China is an adversary and not an ally. Let me talk about one or two more things, and then we'll kind of open it up to some Q&A. Page 19 is a look at the U.S. federal budget deficit or surplus as a percentage of GDP, as a percentage of our annual economic output. The gray bars are the recessionary periods. This goes back to the early 70s. That's what that green line is. The important thing to look at is the horizontal line that goes to zero. Again, when the green line is above zero, the government's balance sheet is spending more than it takes in tax revenues. When the green line is below zero, obviously the government's taking in more tax revenue than it is spending. Where we are today, you can see it, that green line has spiked during the recession of 2020, during the pandemic. All of this fiscal stimulus that I just told you through the CARES Act, Paycheck Protection Program, direct checks to individuals, another round in December, another round almost certainly coming in February. It's put the government's balance sheet in a precarious position. Our government has not been in this large of a deficit since World War II. So this brings in future questions about future economic growth and future economic inflation. There's hundreds and hundreds of years of global history to suggest that when governments take in less money than they earn and put a lot of debt in their balance sheets and have these big fiscal deficits, over time it leads to inflation. Higher inflation means prices go higher, means the incentive to borrow and invest goes lower, and ultimately prospective economic growth is lower. This is the risk that every investor that I talk to today is worried about. So I just told you that all of the help that the government is giving the economy today is a massive tailwind to economic growth in 2021, 2022, almost certainly. We still believe that today, but we have to watch this chart in particular as we move through 2021 and 2022. If that green line doesn't start coming down, I think we're going to start to see inflation start ticking up, and that has future implications for future interest rates and future prospective economic growth. This is the one piece of the pie that we look at on a daily, monthly basis that kind of keeps us up at night. It's not an issue today, but it could be an issue going forward. I will tell you that 10 years ago in 2010, I was in investment committee meetings that saw that green line at 10% of deficit. And we had these same conversations. If the deficit and debt continue to spiral out of control, we're going to see higher inflation and slower growth. We didn't see that in the cycle between 2010 and 2020. We have to watch this going forward to make sure that it doesn't become a problem. The last thing I want to talk about is manufacturing. The next 2 pages, then I'll stop talking here, is a look at where we've been in manufacturing and where we expect to go. We're very sanguine. We're very bullish on the prospects for prospective domestic manufacturing. On the left-hand side of the chart here is the U.S.'s share of manufacturing employment over the last 25 or so years. And you can see between 2000 and 2010, we lost a lot of jobs in manufacturing. Supply chains moved overseas. This is a story that I think everybody on this panel knows about. It was really the introduction of China into the World Trade Organization. China had very, very low factory employee wages, and it was a big incentive to increase profit margins by U.S. Manufacturing firms, and that's exactly what they did. They moved their supply chains and factories over to China. In our eyes, over the last 10 years, that green line on the left-hand side has been essentially flat. So the U.S. has not lost share in manufacturing as a percent of total global employment over the last 10 years. And in fact, we've added about 1.4, 1.5 million manufacturing jobs between 2010 and just prior to the pandemic. So manufacturing has been coming back in our country. It doesn't feel like it. It's not really talked about a lot. And in fact, you hear more of over the last 5 years, manufacturing in the U.S. is dead. That's simply wrong. On the right-hand side, manufacturing employment has been going up, for the last 20 years. The global manufacturing employment has been going up. There's this notion that technology is going to disrupt workers in manufacturing and jobs will go away, being replaced by technology, being replaced by robots, being replaced by machines. That's partly true, but also what happens is technological advances lead to new industries, new services, and new jobs. And that's exactly what we've seen over the last 20 years. Manufacturing globally is not dead. Manufacturing in the United States is not dead. On page 23 here is a look at why, in broad strokes, why we're pretty bullish on the prospects for manufacturing going forward. I want to focus you over here on the cost competitiveness of manufacturing. On the left-hand side of this blue line are the biggest 5 manufacturing countries in the world. And everything's indexed to the United States. This is a cost index as of 2019 from the Boston Consulting Group. They've been doing this study, for the last 20, 25 years. And the way to read it is China at a 95 level versus the US's 100 level is about 5% more efficient or cheaper when it comes to manufacturing output. Germany is about 16% more expensive from a factory output perspective. Japan's about 3% more expensive, and South Korea is right on par with the United States. If we would have looked at this number in the year 2000, China would have been about 80 to the U.S. as 100. And that was the big reason why factories moved overseas. Again, costs were cheaper, wages were cheaper. By moving factories overseas, companies could increase their profit margins. Over the last 20 years, U.S. manufacturing has become far, far, far more cost competitive, and it's not as much of an incentive to move your manufacturing supply chain overseas. That's really, really good news, and we think this gap will continue to shrink prospectively. The other thing that's going on, as we all know on this line, is that there's been some massive disruptions over the past 3 years. First, we had these massive trade wars with China on tariffs. That disrupted supply chains. I can't tell you how many conversations I had with our Fifth Third Banking manufacturing clients during 2018, 2019, first half of 2020, where they could not, these manufacturing business owners could not find raw materials or finished goods at their China supply plants, and they could not get them back to the United States in a timely fashion. The pandemic, same thing last year. China went through the worst of their downturn economically in January, February of 2020. Same thing happened, big supply chain disruptions. The last 4 years, we've all been hearing Make America Great Again. And over the past 7 or 8 months, we've been hearing Build Back Better. So the Republicans, I think, started this manufacturing renaissance over the 2016 to 2020 timeframe. We think the Democrats have picked this up. They're rebranding it. Again, they're not calling it Make America Great Again. We're calling it Build Back Better. We have bipartisan agreement from our politicians today to suggest that this notion that the U.S. government wants these companies to come back home, build factories domestically, employ U.S. workers. This is happening. Our expectation is, again, with this bipartisan agreement, you're going to see tax incentives or subsidies to help entice business owners to continue to bring manufacturing back home. We think this is a very longer term trend. Again, it starts with this cost competitive issue, but I think longer term, it's going to be a political move to kind of goose factories, goose jobs, and it's going to help our economy greatly. So why don't I stop there? Let me end with this one slide. This is probably my favorite slide. A picture tells 1,000 words. This is a look at the U.S. economy over the last 70 years. And the way that I would frame this, again, the gray bars are your recessions. The green areas are cumulative economic expansions during the good times. And the blue lines, the blue areas, are the cumulative economic destruction or contraction during the bad times. And if I had to tell a layman how I would read this slide, is that it's a terrible bet to bet against the American economy. It's a terrible bet to bet against American entrepreneurship, capitalism, innovation, technological advances. These cycles where the American economy is booming tend to last many, many years, and the cumulative economic growth far, far outweighs any kind of contraction that we see in our economy. I could roll this slide back, another 50 to 75 years. It would show the same story. Our economy is cyclical, meaning that there are cyclical upswings and cyclical downswings. That's normal. But for business owners and investors, I think it makes a lot of sense to take a very long-term view. And if we're right, all the way to the right, we are in the very first innings of a new economic expansion. Our expectation is this economic expansion that we're in will last many, many quarters and many, many years. So if I'm a business owner or if I'm an investor and I got the chance to invest in solid companies or myself at the start of a business cycle, I think it's a relatively good bet. So that's it. Let me end there. I want to thank everyone for attending. Thank you so much for the invite. It is a pleasure to be with you all. I really wish we could do this in person, and hopefully next year we'll be able to. So thanks. I'm happy to answer any questions.
Fingers crossed. Thank you, Tom. A lot of really great information. Want to jump into the questions really quickly because we're running out of time. Lots of discussion around PPP. You addressed inflation, your outlook on all of that. Do you see a limit on the dollar amount that the American people receive? Also, an increase in consumer confidence, decrease? What are your thoughts there?
So let's tackle it a couple different ways. I kind of mentioned that we've gotten, in 2020, we got the CARES Act in March, April. That was the PPP program. That was $1,200 checks to families, $600 checks to individuals. We got some more stimulus in December. Again, more checks. We added another $300 some odd billion to the PPP program. So that's still ongoing for people that want to, small businesses that want to attract those funds. And again, what we're talking about today here as we sit in February 23rd is President Biden is going to, through I think a process called reconciliation, is going to pass another huge stimulus package. We think it's going to be about $1.2, $1.3 trillion. There aren't monies earmarked specifically for the PPP program. This one is going to be driven by individual checks to consumer, rebate checks. It's going to be moving up the unemployment benefits to $400 a week on top of what you already get being unemployed. And there's going to be a big amount of dollars going to state and local governments. What I think the purpose of this next round is going to be is to build this last bridge of those seen in the crime industries that are still struggling, build them a bridge to get over this last hump till we get to a point where people are vaccinated and feel confident going back into those seen in the crime industry. So I don't think the PPP program is likely to get a boost. There's still dollars out there if you want them. The PPP program is still open, but expect another round of checks, expect additional unemployment benefits, and definitely expect some money going to state and local governments to help them get past the worst of this last part of the downturn until we achieve some kind of herd immunity with the inoculations and the vaccines. And consumer confidence, our expectation is it's going to continue to rise from here. You're going to get checks in your back pocket from the government. Then again, I think businesses that are in that scene in the crime industries are going to start reopening May, June, and I think those businesses will then, going forward, will have a better chance of surviving than they do today, because you can't operate those businesses without socially distancing today, and it's really affecting their bottom lines.
True. So, and people going out and spending those dollars, obviously that's hopefully to come in the next coming months. But can you discuss the image of the increase of e-commerce on distribution centers, manufacturers?
Yeah, so that is, we talked about that one slide looking at online retail sales as a percentage of total, and we had this huge spike in 2020. And I think it really caught a lot of businesses off guard, how much demand they actually had. And I think we did see some bottlenecks in various supply chains, in various e-commerce back offices in March, April, May, June, even into July and August of last year. I think those bottlenecks, our data would suggest those bottlenecks are starting to clear. What I'm not sure of is that incremental spike that we saw in March, April, May, and June towards e-commerce. Again, I think that trend is not going away. That green line, if you remember that one slide, I can go back to, I think. This is going to continue to go forward. I think what you're going to see is that green line, online retail sales as a percentage of total is going to come down a little bit, but the trend is still going to go higher. What we've seen, at least in the data, again, I think there are some logistical back office supply chains that were not ready for that big spike and it caused those bottlenecks. I think they are getting more in tune and more ready for the potential to have these spikes. But as that percentage of in the near term, retail sales comes down a bit, there won't be as much strain on logistics or supply chains. I can give you anecdotal evidence from myself. We all had problems, I think, sourcing things through Amazon.com back in March, April, May, whether it was toothpaste or soap or shampoo or toilet paper, heaven forbid. It was tough to get those things, and certainly, hand sanitizer and wipes and things like that in March, April, May, and June. It's gotten a lot easier, and it was because that massive spike that we saw during those months of online retail sales when brick and mortar kind of collapsed. Things are improving, and I think lessons learned last year will do this industry very well going forward to build up potential capacity should we see anything like what we saw last year repeat itself, if that makes sense.
Yeah, that does make sense. And again, we are running out of time, but there is one more question that actually came in a couple times, so I want to make sure we address it. You talked about the college numbers, in great detail, but do those reflect the apprenticeship programs, accreditation type programs, specifically in the manufacturing industry? Okay.
No, that's a great question. So I don't know how to put it delicately, so let's just call it what it is. There has been a negative stigma about going to work in a factory for the last 25, 35 years. There's this notion that those are dirty jobs, that those are low-paying jobs. It's wrong. Manufacturing today looks nothing like what manufacturing looked like 25, 30, 50 years ago. These are highly technical places of work. You need to have additional education. You don't necessarily need, a BA in a non-technical field to go work there, but you need some kind of technical training to get these wonderful jobs that are in the manufacturing sector. So these numbers do not look at trade schools at all. I think there may be a shift additionally to these types of trade schools when this stigma attached to historically blue-collar jobs changes. In Ohio, at least, the average manufacturing job as of year-end 2019, that's the latest data that we have, pays about $76,000 a year. The average non-farm payroll job in Ohio pays about $46,000 a year. These manufacturing jobs are really good jobs, and they are highly skilled today. They are not your $12 an hour sweatshops of the 1940s. It's completely different, but this stigma has to change. And I think it's going to take time, but once the financial rewards are more more broadly disseminated, I think it will change, and you'll see a movement a little bit away from here into those trade school type areas. It's a great question.
Yeah, that's great. I'm sure it's very reassuring to a lot of the individuals on the call too. So to be respectful of everybody's time, I'm going to go ahead and turn it over to Carrie. But Tom, I want to thank you so much for your time today. It was very informative. A lot of questions came in, but I know you answered a lot of them as well. So thank you for your time. And Carrie, I'll turn it over to you.
Thank you.
Of course. And Carrie, I'm coming to unmute you.
Okay, thank you, Katie, and thank you, VonLehman, for your partnership in today's event. Special thanks to Tom Jalics for leading our discussion today. I am Carrie Sanders with Fifth Third Bank, and on behalf of both VonLehman and Fifth Third, we want to thank everyone for joining us today. We hope you found value in our discussion. There was a lot to cover, so to the extent anyone has additional questions, please feel free to reach out to your partner at either Fifth Third or VonLehman, and we'd be happy to get those questions answered for you. So with that, that closes out our event today. Thanks again, everyone, for joining us, and we hope you have a great day.